Now that we've got a very good understanding of basic options terminology, and we understand what a strike price is, we understand what the expiration date is, we understand what the options multiplier is, and we understand that there are both call options and put options that give the buyer the right or the option to call away shares or put shares of the underlying option to the seller at a certain point in time or that expiration date that we've talked about. Now, I want to get into selling call options in this video because we've got a pretty in-depth video on how buying call options work and why you would do those. Now we are going to do a video on selling call options, why you would do that, and what the benefits are. So if it sounds like something you're interested in, let's get started. What's up, everybody? I'm Clay. I'm here to make 2022 the best year ever. If you haven't clicked that subscribe button, make sure to subscribe to the channel. Join us, become a bro. We are here every single day, and we are growing our portfolios together. And look, if you're brand new to investing, you don't know how or where to buy stocks and crypto, you got a link in the description below for Webull. It is super simple to set up your account. Any deposit, you guys are getting 6 free stocks. $1 crypto trades, you're going to get $5 in free crypto. And they also have an excellent options trading platform as well. They make it very simple to understand. The user interface is awesome. So if you guys are getting ready to make your first options trade, absolutely think about Webull in the description as well. And let's talk about selling call options, because we've gone over buying call options, but I want to talk about selling call options and why you would even do that. Because we know that buying an option gives you the option to call that stock away. If you are selling the call option, you are obligated. There's a difference. When you have the right or the option to do it, you don't have to. But when you have the obligation to do so, if it gets called away from you, you have the obligation to give those shares up. So why would you ever want to do that? Selling a call option is an excellent way to generate income as a stockholder. Think about it. If you're holding shares of, let's use AMC as an example. If you're holding shares of AMC Entertainment and you believe the stock price is going to go up long term, but it's kind of sitting sideways in the midterm, or it might even go lower in the midterm, you don't want to just sit there and lose money as it goes down or sit sideways. You can generate income on a weekly basis on your position, and all you have to do is sell a call option. Now, this is a slightly more intermediate, I guess, options trade than going out there and simply buying a call option. But this stock option trade allows you to generate income on a weekly basis. Think about it. If you have a decent sized portfolio, you can generate a paycheck on a weekly basis, on a bi-weekly basis, on a monthly basis, whatever your intentions are. You can do that simply through call options. The underlying stock that you're buying right now doesn't pay a dividend. Make them pay a dividend in the fact that you can generate your own income selling a call option. So what does this look like? How does this work? And let's get into an example. We know the main reason we would be doing this is to either generate income to alleviate and offset some of the future losses that we may incur, or simply to generate income as the stock price trades sideways or goes slowly up in value. Either way, it could be a win-win-win situation for you. And let's discuss some examples as to why selling a call option might be something you're interested in. So we have AMC, for example, and it's trading at $20 per share. Now, AMC is rather volatile, but let's say that it's been sitting at $20 for months now. Maybe it's gone up to $22, maybe it's gone down to $19, but it's been trading right around that level for quite some time. Now, you can sell a call option, and you can choose the strike price, and you can choose the expiration. Now, things we need to keep in mind. The further out the strike price, meaning the further away from the current stock price it is, the less valuable that option is going to be, and therefore it makes sense for a buyer because it's cheaper, but for a seller, you're going to be able to generate less income. So that's something to think about. but it's less likely to get called away as well. The expiration date. The further out the expiration date is, the more expensive that call option is going to be. Therefore, if you sell a call option with a very far out expiration date, you're going to be able to generate a larger income or generate what they call a larger premium because there's more extrinsic value associated with that call option. Now, we will get a little bit more into detail on intrinsic and extrinsic value as the series progresses, but absolutely just know that intrinsic value means how much that stock option is currently worth based on the difference in strike price and stock price. Extrinsic value is the time value of that stock option. And it simply means that the more time you have, the more valuable that option is. Now, let's say that you're looking and AMC has not gone above $25 per share in the last 5 months, and you don't think it's going to go above $25 per share again. You can still be bullish on AMC, and you can still sell a call option if you are bullish. What does that look like? You sell a call option at a $30 strike price. Now, we haven't seen $30 in quite some time, and there's very low risk of AMC, or very low chance of AMC going above $30. But nonetheless, you're able to generate a premium. And let's say you can generate, I don't know, $20, $30 per share. Since the stock price is $20, let's say you can generate a $50 premium, okay, by selling that $30 strike price. Now, what you do is you sell that call option at the $30 strike price, and you receive immediately a $50 premium. Now, remember, you have to look at the expiration date. Let's say it expires at the end of the month. Now, you are obligated as the seller, and your broker will make sure you follow through with that obligation to sell those shares. So don't think that you're going to be able to get away with it and, close your account or anything like that. Your broker will make sure you follow through with your obligations. You are obligated to sell that if you do get called away or if that stock option gets exercised. But what we're looking here, a couple different scenarios. AMC at the end of the month, it's trading at $29 per share. You not only made $9 per share that you own, you also brought in that $50 premium. Remember the income you generated selling that option, but you are not going to get exercised on. Why? Nobody's going to pay you $30 per share when they can go out there and they can pay $29 per share on the open market. So in this case, you made the $9 per share because AMC went from 20 to 29. You also kept your $50 premium, and you don't have to worry about getting exercised. That call option expires worthless, and you're ready to go for round 2. Now, let's say that AMC drops from $20 per share down to $19 per share. You lost some money over the course of that month, but remember, you also brought in that income of $50 that you had in that premium for selling that call option. You see, either scenario here, you did not have your shares called away, but you were able to generate income, keep your shares, and in scenario A, you made money on both the premium and you made money on the underlying shares of AMC. And in scenario B, you made the money on the premium, which offset some of your losses in AMC. So it was a great way to generate some income on your position, and you were still bullish along the way, and AMC was still able to make you money. Now, let's look at a third and final scenario. If AMC at any time during the month is trading at $35, $40, $45, $50 per share, what's going to happen? There's a very high likelihood that the buyer of that option that you sold it to will exercise that option. And if that happens, they will be calling away your shares of stock. So you have essentially capped your gains on the underlying stock at $30 per share. Remember, they still have to pay you $30 per share. So you're still going to walk away with selling your shares at $30, which is a nice gain from the $20 per share that it was currently trading at. And you received that $50 premium that you made by selling that call option. So all three of these scenarios, you were able to generate income and you were either, the worst case scenario is when you got called away and you limited your gains to the $30 per share, and somehow it ran well beyond that. So selling call options is an amazing way to generate income, not only when the stock is moving sideways, not only when the stock is moving down, but even when the stock is moving up as well. So things to consider when selling a call option: look at the strike price, look at the expiration date, understand that the further out the expiration and the closer or more in the money the stock is, the higher premium you will be able to generate, but the more likely you could be to be called away in a situation like that. So guys, I want to know what you think. Let me know your thoughts on selling call options down in the comments below and generating income as opposed to waiting for a dividend or anything like that. Let me know your guys' thoughts down there on making your own paychecks. And of course, if this button right here is still red, make sure to click it, subscribe to the channel, join us, become a bro. We are here every single day and we are growing our portfolios together. You guys got ClayBro883 on Twitter and Instagram, getting 6 free stocks on Webull, free Discord in the description below. And until the next time, hope that each and every one of you have an awesome day.